Very good afternoon to all of you. The topic for today's live webinar is Management Accounting as a Tool for Prevention and Control of Fraud. The learned speaker for this topic is CA Pradeep Godbole-ji. And before we start the program, I would like to give a brief introduction of C. Anuj Goyal-ji, who is Chairman of Committee on Management Accounting. He is also the Chairman of Research Committee, which is the oldest technical committee of the ICAI. This is his fifth term in the Council of ICAI, with his rich experience of 14 years in Council, 3 years in Regional Council and 6 years in branch. He was also the Chairman of the Central India Regional Council. At the academic front, he is a meritorious scholar possessing qualification of CA, CS, ICAI, LLB, MCOM, DISA and DIRM. With this brief introduction, may I request C. Anuj Goyal-ji to kindly give his welcome address and opening remarks and also introduce the speaker. C. Anuj Goyal, sir. Thank you.
Thank you, Dr. Surendra Pal-ji. I welcome our honorable guest speaker, Pradeep sir, who is going to cover very important topic for the cause of the
So we are unable to hear you due to internet connection.
Pradeep ji, what topic we are going to cover today?
So we'll be covering management accounting as a tool for prevention and control of fraud.
Great. So may I request Vaisali ji for the introduction of our guest speaker, Pradeep sir.
Thank you so much, sir, for giving me an opportunity to introduce our eminent faculty. C. Pradeep Godbole, sir. He is a chartered accountant with rich experience of 30+ years in banking and financial services, business and technology consulting, auditing, accounting, and also management experience. He also worked in various reputed organizations, Big Four consulting firm, as a senior management position. He is also independent director at South Indian Bank. He was chairman of IT Strategy Committee and member of board committees. Additionally, he is also a speaker at various professional events and seminars, in addition to as a guest faculty at our Institute of Chartered Accountant of India. With this brief introduction, I would like to hand over mic to our eminent faculty to address the participants.
Okay, thank you Vaishali ji, thank you Anuj ji and Dr. Pal. I try to put the presentation in the presentation board. Give me a minute. Give me a minute.
Management accounting as a tool for prevention and control of fraud is very important topic which our honorable guest speaker Pradeep ji is going to take, and I am quite confident that all the viewers will appreciate that this is a time when the chartered accountants has to and the professionals has to come forward and to see that how we can give the value addition in the best possible manner to the trade and industry. and beyond compliance, beyond a test function, how we can contribute as a professional so that the vision of the Prime Minister Modi of Atmanirbhar Bharat can be achieved. And I am quite confident that the members of the Institute of Chartered Accountants of India, who have passed the toughest examination of the world, are competent enough to handhold the trade and industry and the management accounting. You see, I always say that the cost accountancy paper of ICAI is tougher than the cost accountancy paper of the CMA. And at times it happens that a cost accountant who appear in the cost accounting paper of ICAI do fail in the cost accountancy paper of ICAI itself, because we are having the best of the controls, and we are having the expertise in cost accounting, we are having the expertise in management accounting, and we are undoubtedly the best accounting professionals for the management accounting. And management accounting can be used as a tool for prevention and control of fraud. And now this is the time when we have to see that how we can compete not only in Indian market but also in international market. And for that we have to bring the costs down. We have to stop the leakages. And I'm quite confident that after the deliberation of Pradeep sir, all of us will certainly see that how we can help out the management for prevention and control of fraud. And friends, fraud control is considered an essential aspect of organizational risk management, and one of the fundamental aspects of fraud prevention and detection in an organization is the requirement that management must continually pay close attention to effective management basics. An efficient management accounting system is the key to a structured and well-ordered system of financial information flow and analysis that enables the organization to take appropriate and timely decisions. This is particularly true where fraud control is concerned. Organizations cannot be effective at preventing or detecting fraud without the right information that is accurately analyzed and interpreted. There is a pivotal role here for the management accountant to enhance an organization's capacity to fight fraud. Management accounting lays down a proper fraud control strategy to incorporate the four aspects of prevention, detection, deterrence, and response. None of these can be effectively executed without sufficient and proper data analysis and adequate consideration of fraud as part of an overall risk management framework. Friends, management accounting provides comprehensive understanding of an organization's structure, operational environment, and financial activity, and management accountants have the critical expertise and knowledge essential. Management accountants are the key participants in effective fund risk management. So I am quite confident that all of us will certainly see that how we can do this value addition to the trade and industry as a business solution provider, whether we are in practice as a consultant or whether we are in industry as the head of the finance division, as CFO, or even as a CEO. And the traditional types of frauds are still the most common, and they require continual management attention to basics. Companies always are vulnerable to theft of cash or other assets. However, in present digital age, adequate background checks of employees are also essential, as there should be an ongoing program for monitoring and evaluating internal control. Management accounting reporting always display red flags for material facts. Management must respond immediately to any warning sign and not follow the belief that we are a small town business and employees are from our local area. There is no reason to suspect fraud because our employees are trustworthy and competent. Unfortunately, many companies learn too late that certain employees are able to commit fraud because management does consider them trustworthy. And I believe the highlights of the topic to be covered during webinar will be setting the context, fraud triangle and types of frauds, management accounting versus financial accounting, management accounting techniques for fraud prevention and control, examples of management accounting for fraud prevention and control, industry specific view, how banking industry uses management accounting for fraud prevention and control. So friends, I am quite confident that our learned speaker will certainly see that how our chartered accountants can really contribute, whether we are in practice or whether we are in industry in this regard. And I will request all the viewers to please raise your queries. And I will request Pradeep sir that at the end of the webinar, please respond to the queries of the participants. With these words, I once again welcome our honorable guest speaker and all the participants. Thank you very much. And I will request Pradeep sir for his words of wisdom, please.
Thank you, Anuj. Thanks for the introduction, and you have set the context very well. And a couple of points which you have mentioned, I will try to cover them in slightly more detail as we go along. So let me start off by sharing my screen, and I hope you are able to see my screen. Let me put it in the presentation board. Are you able to see this screen?
Yes. Yeah.
Yes, sir.
Okay. So as the topic you are seeing today, so all of us are champions in accounting and cost accounting and management accounting, as Anuj sir was saying. So what we are trying to do over here is that the traditional way of management accounting, or the way in which the management accounting is being looked at, it can be further extended, and we can add value to the organization where we are working or where we are consultants in terms of fraud prevention and fraud control. And we will see how that can be done, what are the tools and techniques which can be achieved. So before I start off, when I had to do this webinar, I was trying to do some research about the amount of frauds, particularly in the Indian context. Unfortunately, I was not able to get a very good handle on what is the amount of the frauds, except the banking and financial services industry, where RBI has published, every year it publishes the amount of frauds, numbers, as well as the amounts which are there, which are happening in the banking industry, which is there. And if I pick up the latest figure of March 20, you will be shocked to know that the amount of frauds which have happened is over 1,09,000 crores, and almost more than 80% of that is a credit fraud, which involved either the manipulated financial statements or fund diversion or asset misappropriation or providing fictitious values of the assets, money laundering, all kinds of things which are there. So this is the figure which is there. If you add up the figures amongst all the other industries, be it in manufacturing, be it in telecom, be it in healthcare, in insurance, and all these other industries, if you add, this figure will be really going to a staggering level. And this is where we are seeing how the management accounting can work. So before we jump into the tools and techniques, what I would like to do is to cover this fraud triangle. We have to understand why the frauds occur, what is the motivation behind doing the frauds, what is the thought process of the fraudsters, why they do the frauds, and what kind of rationalizations they come up with. So all of us have studied law, and we know what the definition of fraud from the legal terminology. But if you take it as a pure layman language, fraud means something, an act which is done to get a wrongful gain for one person and a wrongful loss to the other person. And this could be done by concealment of facts, or maybe there are various means which will be there to get that wrongful gain. Now, why do the fraudsters engage into fraud? And there has typically this fraud triangle which is there is describes, if we understand why the frauds happen, what is the motivation behind fraud, then you can take the corrective steps to prevent it or the control it or detect it. So that is why this analysis is slightly more important, and I would spend few minutes only on this particular slide. So in terms of motivation, the first one is need and greed. We all know that nowadays the excuse me.
Yeah.
So in terms of targets which are being set up, everything is linked with that. So people will try to fudge the records to show that they have met the sales target. They would like to get the sales commission for it. In many cases, the compensation is also linked to the achievement of certain level of profits. The bonuses are also linked along with that. The salary hike is linked to the performance or the target achievement which is there. So that kind of a situation will motivate the employees or the staff to do some wrongdoing and make sure that they are able to get that personal benefits which are there. Another factor which is there is the employee stock options, where the employees are entitled to the stock options based on the achievement of the targets and the sales. If you show a better performance for the company, then the share price will be higher and you will gain higher benefit. This was one of the reasons of fraud in case of Enron, which almost lost $74 billion for US investors. So that is what is one of the first reasons which is there. Second reason is the personality and temperament. What we mean by that is the personality traits which you have got. So if somebody has got a gambling habit or a drinking habit, he will face financial problems. He will be inclined to do the fraud, especially cash is more vulnerable in such cases. If the cashier is having such habits, he will have that kind of a risk which will be there. Ethics and values is another very important thing that is very important from the personal level as well as at the management level which is there. All of us have heard the term tone at the top. So how the management looks at such things. Does it tolerate the behavior, such fraudulent behavior, or does it have high level of integrity, ethics and values which are there? Recently, you must have seen the web series Dirty Money, and there was a episode on Wachovia in that. So what happened in case of Wachovia is that the management actually forced the employees to open new accounts. Now, within a county, there will be a certain number of people who can open the accounts. So they exhausted that. So there was a continuous management push to achieve the targets, to show higher growth, and all that kind of stuff. And the management was not very careful in terms of ethics and values. So what the staff in turn ended up doing was that they opened accounts for the retired employees. They gave the cards to such people and the charges were levied on that. And such poor people were not able to pay those charges. So ethics and integrity again becomes very, very important. So first is the motivation. Now, if you have the motivation, you should also have the opportunity to do a fraud. So why do the fraud will occur? The fraud will occur because of the first is the inherent risk itself which is there. So for example, cash is the most liquid, most fungible asset. It lacks the audit trail of changing hands. So it's more fraud prone. Traditionally, some of the organizational units are also treated as fraud prone. For example, purchasing or vendor management, which is there, right? So weak internal control system, the poor security over the assets, there is no fear that the fraud will be caught. Then the employees will be motivated to do frauds. sometimes the policies are not very clear how a particular thing should be done, and that gives a leeway for the employees to exploit the advantages which are there. So you have the motivation, you have the opportunity. And the third factor in this case is that you typically, if you look at it, the fraudsters will try to rationalize their actions. And this rationalization can happen typically because of the peer pressure. So, for example, there are 10 people in the department and 9 of them are indulging, undesirable activities. There is that single person will be under a pressure. He will also be forced to take up such activities as a fear of getting caught or getting shamed or peer pressure kind of a thing. In many cases, the fraudsters will say that this was necessary to meet the business needs which are there. So that is one other thing, especially in case of loan covenants and all that, where the frauds have happened. There is a manipulation in the stock and book date statement. This has been the typical alibi which was taken, like that it is necessary. In some cases, the fraudster will say that what I'm doing is not going to cause much of a harm to the organization. It's a harmless activity. I make money. Organization is not at risk. So it is okay to do that kind of a thing. And finally, some people who say that, okay, organization has done something wrong with me, so that's why I'm entitled to do that kind of a thing. They will try to justify it. So the key takeaway which I would like to leave you on this slide is that if you want to prevent or control fraud, you need to understand who is likely to commit the fraud, where the fraud is likely to occur, what will be the motivation which will be there, what is the policies, procedure, control situations in that area which will allow them an opportunity to do the fraud. If you have that thought process in place, then you can undertake all the control activities for preventing, for detection, control, management, all those activities what Anuj was talking. One other interesting factor which has come out in recent surveys is that the profile of the fraudsters is changing drastically. Nowadays, you might find that the fraudsters who have committed frauds, they will be typically middle-aged men or women who will be there. They will not have a substantial criminal history which will be there. And many a times they will be the first time offenders which will be there. So that kind of a profile knowledge is also very, very important if you have to prevent or control the frauds. I'll move to the next slide. So once you have understood the motivation, the opportunity, and the rationalization which is happening, who is likely to commit fraud, the next important thing we should know is that what are the types of frauds which are likely to occur or which are happening in the marketplace. If you know how they are happening, what are the types of frauds which are happening, then you will be able to devise a suitable control and detection mechanism which is there. So if I look at the various types of frauds, and if you look at the textbook literature, you may find a different slice and dice of this particular diagram. So the first and the most important of the lot is the asset misappropriation. So as Anuj said, cash is one of the most vulnerable asset which is there. It is fungible assets. It's a liquid assets. Easy. There is no audit trail when the cash changes hands. So it is very much easy. So you will find such frauds happening in case of petty cash related transactions which are there. In case of falsified documentation or reconciliation not happening, or the reconciliation which is happening, but the frauds which are happening is camouflaged while doing that reconciliation by the person who is doing that kind of reconciliation. The cash fraud can also take a shape in form of deposits. So where we have heard the term kiting. So kiting is one of the mechanisms which will be used to camouflage the deposit-related fraud which is there. You will try to put in the money which is far. You will try to issue the check far in excess of the balance in your account. You will try to fund an account through a check of the another bank, and that kind of a process will continue. Again, reconciliation becomes very, very important in this particular case. So cash is one of the most important thing subject to theft, which is there. So typically you will find that there are controls which have been laid out in terms of the dual custody, the control over the cash box, which is there, the periodic balancing, day balancing, which is there. You will have the reconciliation, which is happening, the periodical cash verification, which will be happening. So that kind of controls you will typically find which would have been implemented. The second set of cash-related frauds which could be there is in terms of payments, which could be check forgery, or where there could be changes to the payee or the amount which is there. Or it could be a payroll-related fraud where there will be ghost employees which will be added to the list of employees which are there. Or there could be falsifying of the commission or wages or the salaries which are being paid. Which are there. This type of a thing was actually noticed in case of India, in case of Satyam. This was one of the ways in which the fraud was perpetrated was to have ghost employees which were added to show that there has been income and there has been activity which has been happening. Expenses, again, there could be overstatement, or you can book fictitious expenses, or you can have multiple reimbursement which will be there. There could be problems in frauds in the vendor payments, where there could be payments made to the shell companies or the companies where the employees' relatives are associated with it. Or in some cases, personal expenses itself could be booked under the company heads which are there. Second set of asset misappropriation can happen in terms of the inventory and the other asset. So inventory, again, is one of the very, very important type of assets which can be manipulated very easily in terms of the quantity as well as in value. So you will find that there are false purchases which are being recorded, or there are false sales which are and shipping which has been shown out of this. There could be theft of the inventory which might be there, or there could be wrongful or unauthorized write-offs which will be happening to the inventory. And finally, it could be that the inventories which are there, they are being used for the personal gains. So again, in terms of controls, we have seen that there is a documentation which has been maintained. There is a dual control, 4I principle, segregation of duties is maintained in various activities which are there. The stock verification is done, periodic stock audits are done. All these things are done as far as the inventory is concerned. In terms of other assets, you might find the asset misappropriation happening in case of plant and machinery, where there could be fictitious recording or transfer which might be happening, fictitious write-offs might be happening. One last item in case of assets is the intellectual property. Now, this is becoming very, very important in case of today's world, where the intellectual property rights, the formulas which we have developed, the business secrets which we have developed, and typically the competitors or the fraudsters, or even in some cases, the governmental agencies are involved in an organized way to conduct a fraud or steal these type of intellectual properties which are there. So asset misappropriation is one very, very important sort of block which is there. Second block, which is again very, very important, is the financial statement fraud, where you will find that the assets or the revenues will be typically overstated vis-a-vis the values what they have got. So you will record fictitious revenue. You will have the improper classification which will be there vis-a-vis current versus non-current which is there. The asset valuation itself, you can have the valuation done in a wrongful fashion, in a fraudulent fashion. If there are assets, for example, like derivatives which are there, where the valuation becomes very, very difficult. This is one other area where the frauds can typically happen. One other way of financial statement fraud could be the timing differences, which will be there, where you will try to push the expenses in the subsequent period to show higher profit, that kind of a thing which will be there. You will try to conceal the liability or the expenses which are there. On the other side, you may have the liability or expense related understatement which is there. So you will have the incorrect recording of liabilities or expenses which are there. You can have the timing differences. You can also have the principles related issues, like whether how that particular item needs to be accounted, and you will try to take a refuge under some kind of interpretation which will be there. Again, wherever there is an asset or a liability where estimation is involved, that particular item inherently is prone to risk which is there, which is prone to fraud, I would say. So that kind of a thing which will be there. So in terms of our expertise, in terms of management accounting, these two types of blocks which are there, they will be the most useful in terms of prevention and control, where our tools and techniques can be used very, very effectively. Having said that, it does not mean that the remaining blocks on the right-hand side, we cannot use those techniques. And I will try to explain some of those techniques in those blocks also. But by and large, the first two blocks are where the management accounting is likely to give you a better result vis-a-vis the other three blocks which are there. So the third, in terms of the first two blocks, if you look at it, there are a couple of frauds which I mentioned, which have happened in recent times, in last 15, 20 years. Enron fraud happened in 2001, where the management actually indulged in complex derivatives. These complex derivatives were kept in the off-balance sheet as off-balance sheet items in subsidiaries, and they used the accounting lacunas which were there to hide those losses. And one fine day, those losses were so high that Enron became bankrupt, and the investors lost almost $74 billion worth of money. The other one which I quoted was Satyam in India, where the management indulged in the fraud, where they put in ghost employees to show higher revenue. They wanted to show higher profits by doing such an activity. They also manipulated the bank statements to show higher bank balances. They also manipulated the other assets and the values which were there. And that was somewhere in the region of almost more than 10,000 crores which are there. So this type of frauds have been happening in recent times. And you might find many more such cases than what I have quoted over here. The third block which we should understand is the corruption, I would say. The corruption will happen typically in two ways. One is the conflict of interest, where the person, the staff itself or their immediate relatives will have some interest in the deal which is there. So they may run a front-running company or a shell company through which those activities will be done, and the contracts will be awarded to that particular company which will be there. So that kind of a thing will be there. There could be bribery also, which might be there, which can take some different forms, like say bid rigging. So where the RFP is running for some time, and you will find that the clauses in the request for proposal which is there will be changed. The bids will be rigged, the prices will be rigged, which will be there. There, in many cases, there could be situations where the people involved may be taking kickbacks in financial as well as non-financial. So non-financial could be in form of foreign trips or gifts or diamond sets, all that kind of stuff which will be there. Some people actually put even the types of frauds like money laundering and the tax fraud under this particular bucket. Some people put it under different category, but that is also one of the very, very important fraud which is there. If you compare the first two types of frauds, corruption is typically very difficult to detect through the normal means which are there. The organizations will put controls around it. You may be able to find some indicators, but you will not be able to prove it conclusively unless you do a proper, thorough investigation and you gather evidence. So to that extent, this type of fraud is slightly difficult to handle. But having said that, there are indicators which you can put in, which will help you to get some ideas, and we will talk about such indicators in the subsequent slides which are there. The fourth type which is there is the technology fraud, which is becoming very prominent in today's world with the advent of technology, various payment mechanisms which are coming in place. The technology is advancing, you can do the transaction cross-border. So all this has given also an opportunity for the fraudsters to exploit the loopholes which are there in the technology processes which are there. Here you can divide the types into two parts. One is the information security, where you may have a situation very commonly, you might have heard about it, is the password sharing or OTP or CVV sharing which is there. In some cases, the fraudsters have got unauthorized access and made some fraudulent payments which are there. There could be identity theft which might be there. In some cases, the fraudsters have sort of invented some kind of innovative tools which are there, like phishing, where they will send a mail to you. You click on the mail and your account will get hacked. Or it could be phishing, where the telecaller will call you and try to get that information from you. You must have seen the web series around it, which was there, which talked about this kind of thing. It could be email spoofing kind of a thing will be there, that you will see that the email is coming to you from a legitimate source or from your boss, but it will ask you to do something, transfer the money and all that kind of stuff. And that kind of a thing will be there. So information security, it could be external sort of oriented, or it could be internally the person sharing the information or doing some activities which is exposing him to the fraud which is there. The second set, which is a very larger set, and this is a cause of concerns for not only the organizations but even the governments, is the cyber risk, which is a very, very sophisticated attack on the technology assets of the organizations which are there. They could be organizations like banks or payment systems or even government websites which are there. So there will be a sort of concerted attacks which will be carried out, right? So in that case, you may have some kind of various types which are there, like denial of service, where you will not be able to access the bank's website, or distributed denial of service, where the attack will happen from multiple sort of laptops or the desktops which are there, and it will be done through thousands of computers to block the entire network which is there. It could be a spamming, where you will send a lot of emails which will block your email network which is there. It could be virus or malware attack, that kind of a thing which will be there. Or in some cases, there are sophisticated mechanisms which are being used, like advanced persistent threat. So here the fraudster doesn't attack on day one. It keeps observing what is happening in the organization, and when the timing is suitable, then only that fraudster will attack, right? So this management accounting typically may not be able to help out on such things. But having said that, lot of risk indicators which can be set up, they will not be truly an accounting type of activities which will be there, but a lot of indicators can be set up to see what is there any drastic increase in the volume of transactions which are happening, and so you can take control of that. So that kind of a thing you will be able to do through using for the technology related frauds which are there. And finally, the industry specific fraud, which is relating to, say, banking or cards or insurance, IT, healthcare, which is there. Having looked at all these things, what I would like you to leave you with is that fraud is a type of risk which should be measured. And how do we measure the fraud risk? So fraud risk will be measured as the impact multiplied by the likelihood of that fraud event, right? So if the impact is catastrophic, like say cyber risk, which is there, but the likelihood is that you are not expecting that attack to happen every day. But once that event happens, it will be a catastrophic impact in terms of your operations, in terms of your the impact which will be there in terms of reputation to you. So that is how you will try to measure. And what you will try to do is to use the proportionality principle. So higher the risk, higher will be the rigor of the control and monitoring you will try to put in. This is very much required because when you put in the control, there is a cost associated with it. So if you are putting in the control, there will be a cost. Now that cost has to be offset by the benefit which you are getting, which is to avoid that amount of fraud which is there. So if you are using the proportionality principle, you will apply the required amount of force in line with the risk which is there. The fraud prevention and control, which we are talking about, that will aim to reduce. What we are talking about is the impact. Either it will try to reduce the impact, or it will try to reduce the likelihood of that event happening, or it will reduce both. Impact as well will be reduced, as well as the likelihood will also be reduced. So when you are using the management accounting as a tool for fraud prevention and control, you have to also make sure that not only it should prevent the frauds, but you should be able to detect the frauds in the early stages. So you should be able to find out if there are any anomalies which are there. You should be able to find out which can be acted upon swiftly, and you can contain the damage which is there. And that is where the management accounting can add value in terms of preventing, in terms of identification, detection, and controlling of these frauds which are there. So coming back to the two major blocks, what we talked, asset misappropriation and the financial statement frauds. So here what is happening is that it is a misappropriation of the assets or the cash flows which are there. Or what is happening is that there is a change in the balance sheet structure which is there. So if you are able to put in the controls relating to that, or if you are able to use the tools and techniques of management accounting around it, then you in a much better fashion. So what I will do is that I will spend a couple of minutes only on this particular slide. All of us know what is the difference between the financial accounting and the management accounting. I don't have to explain that in greater detail, but still I'm putting this slide because I would like to drive home a point which will be useful for us in the subsequent discussion. So if you look at the whole process, if you, as they call it in the linguistic terms, if you open the bonnet and look at the engine, what is really happening is that the business activities will happen, which will have result in transactions. These transactions will get recorded, they will be classified, posted, and summarized. So if you open the bonnet, what is really happening is that you are capturing the data relating to that particular transaction. So you will be capturing the customer ID, you will capturing its GST number, you will capturing its GST rate, you will be capturing the quantity, price, what is the amount which is there, where is the place where the goods are dispatched. All this is a data capture. Based on this, what you can do is that you can extract them. You can get some meaningful information out of it. So you can look at this particular data which is captured, say thousands of invoices data has been captured. You can now look at it and analyze this data, and you can get meaningful information out of it, and you can do analysis based on it. And we, as an accountant, we do a lot of analysis in terms of financial statement, which will get into the financial reporting which is there. If you come to the management accounting side, what additionally is required is that we will do additional analysis. For example, in case of sales, the financial accounting will show that the sales is 100 crores. But in management accounting, you will drill it down to see which are the regions which have contributed to that 100 crores, which are the products which have contributed to that 100 crores, who are the customers who have contributed to that particular 100 crores. So you will try to extract the knowledge out of it. And based on that, you can take action. So for example, you see that the growth potential is very much in the Western region. You can take some marketing campaigns in the Western region. That is how we have been using the management accounting for efficiency measurement, improvement, and the sound business decision making. All of us chartered accountants are champions in terms of this analysis which is there. So what is happening on this management accounting side is that you can use that same analysis for fraud prevention and control, and we will see what kind of tools and techniques which can be used for this particular purpose. So what is happening is that for the purpose of fraud prevention and control, what we will require is that additional data we may have to capture. Just the way I said, I explained to you about the customers and all that, which might be coming out of your financial accounting records itself. You don't have to do anything, but it may happen that you may, for your business decision making, you have looked at, say, electricity expenses. You will also look at how many units are consumed and can you do something about it. So not only financial data you will use, but you may also use the non-financial data which is there. You will also use some ratios which are there. In addition to your normal financial ratios which we use, there could be additional ratios which might be used as part of management accounting. And those ratios will help us in terms of identification of the fraud-prone areas, prevention of the fraud, and the control of fraud which is there. So that is what is how the whole process can work out. So the key takeaway for on this slide, which I would like to leave you with, is that for fraud prevention and control, we will require additional data or calibration of the information which we are already capturing, or we may capture some non-financial data which will be there, and that may be useful in terms of preventing fraud. So just to take back that example of cyber risk, what typically will happen is that the institution will have put in some tools and technology around it to find out what is the network activity which is there. So as soon as the network activity increases, there will be an alert which will be going to the concerned people to look at that there is a sort of adverse activity which is happening, which is not in line with your normal expectations, and that will be an alert which will be there. So this will be a sort of non-financial kind of a alert which will be there, or a warning signal which will come, and this will also be part of management accounting. So when I'm looking at management accounting, I'm not constraining myself with the traditional accounting records only. It has to be expanded to cover all these areas which are there. And as we go along, we will see that not only these type of alerts, but there are some other forms of data which is coming up nowadays, which is helpful in terms of fraud prevention and control, which is there. So before we move on, actually, so in terms of the way in which the management accounting can help in terms of the preventing frauds which are there. So we can use some of the tools and techniques which are there to find out which are the red flags or the warning signals which are there, which is what Anuj sir was talking about. So we can identify that. That can be taken up for investigation, and based on that, you will identify the reason. It may turn out that there is no fraud, but in many cases, it will turn out that that indicator or red herring which you are getting is an actual case of fraud, which is underlying and which is being hiding in this particular case. Right. So that is what we will have to take a sort of process if we have to do a fraud prevention and control using the management accounting. Give me a minute. I hope I'm audible and I'm making sense. You are able to get what I'm talking about.
Yes, sir. Yes, sir.
Okay. So what we will now go in and discuss is what kind of management accounting tools and techniques which we can use for fraud prevention and control. And I have tried to put very simple boxes which are there, and I will try to explain each of these boxes how we can use our expertise which is there. As chartered accountants, we have got accounting expertise, we have the legal expertise, we have got the cost and management accounting expertise, what Anuj sir was talking. So how we can leverage that for this additional service or active where we can add value. So I'm dividing the the tools and techniques in three buckets which are there. The first one is a financial bucket, and you must have seen this multiple times, and you all understand it, but I'm trying to relate it to the fraud prevention angle, how we can use it to our advantage. So we all know what is a contribution margin, that it is the difference between the revenue and the variable costs which are there, which we use for evaluating the profitability across the product lines, geographies, regions, and all so on and so forth. So this variable costs are linked to the sales volume. So the contribution margin is typically expected to remain stable. You are not expecting a vast variation that this quarter the contribution margin is say 20%. Next quarter it is going to become 50%. The next quarter it is going to become 10%. You are not expected that kind of a thing. If you see such kind of wide spikes in the contribution margin, there is certainly something which is cooking up as you can draw that conclusion, right? So whether that contribution margin is changing dramatically from one period to the other is one of the things which is there. I would like to give you an example of how this particular thing can be used. There is a US company called KOSS, KOSS, and they make headphones. So here what the employees were doing was that they were underreporting the sales. They were concealing the sales and they were pocketing the gains which were there. So if you would use this contribution margin kind of a thing instead of traditional financial statement which we do, where we will take the revenue and take out the fixed and variable costs together and you will get the gross profit margin. Instead of that, if you take the contribution margin, you will find that what are the variable costs, what are the fixed costs. Fixed costs are expected to remain constant. Variable are expected to change vis-a-vis the sales volumes which are there. So if you try to conceal the sales, your variable costs are not going to change. They are going to remain constant. So your contribution margin will show a negative sort of trend which will be there, and which can be a sort of indicator for you that something is going wrong, and you have to look at it in much more detail which is there, right? So that is the kind of a thing how you can use the contribution margin ratio to find out some of the deviations which are there. You can even further drill down at the product level to see which products are showing a different margin and whether there is something going wrong in that particular case, right? So that is the way you can use the contribution margin. The second technique which we all of us know is the budgeting and variance analysis. So budget is again what you draw up for the future activities which you are going to carry out. You will take into account your existing situation, your future projections, the market feedback, what are the changes which are going to happen in the economy. And typically all the parts of the organization will typically involve in the budgeting exercise which will be there, right? So through the budgets, what you are expecting is what is expected to happen in a normal situation. And variance analysis will tell you that what has happened which is not in line with your original estimates which are there, the budgets which are there, and these could be an unusual situation which will be there. So again, budget variance and analysis can be used very, very effectively in case of say kickback schemes involving purchase function especially. right? So you can use that kind of a thing. I mentioned before that kickbacks and corruption is very difficult to find out, but some of the indicators you can put in and you can find out whether something is going wrong. So variance analysis will be one such case which might be there. So you can look at the purchase price variance. So if the purchase price variance is adverse, then what it means is that you are purchasing the goods at an adverse price, and that could potentially tell you, it is not certain that there is a fraud. There could be genuine reasons why there is a price variance which is there, but there could be a situation where the price variance is negative because there is some kind of underhand dealing which is happening through the kickback scheme which is there. The similar case you can find out on the material usage variance which is there. So if there is a large unfavorable usage variance which is there, it will show that there could be a theft which might be happening, or there could be a shrinkage which might be happening, or there could be non-receipt of the merchandise which is there, or under reporting of the shipments which are there. So that kind of a thing which you will be able to see through the variance analysis which is there, which can be used very, very effectively. It is not a foolproof mechanism. In fact, any of these mechanisms which are there, they are not foolproof to say that, yes, there is a fraud, but they are the possible indicators. It will lead you to the fraud. It will lead you to further investigation, and you will be able to prevent and detect fraud because of this. The third important thing which is used is the ratio analysis. We are champions as financial statement experts, auditing as well as accounting which is there. So these are ratios will show the relationship between two variables. We talked about contribution margin ratio. So similar kind of a thing which you can have in terms of the different ratios which are there. So typically in a banking situation, especially if there is a wide fluctuation in the say gross profit or the net profit which is there, or the margins which are there, then it is one sort of indicator which is there that there could be something wrong which might be happening in this particular case, and where we might have to pay close attention to all these aspects which are there. So ratio analysis again could be looked at. One other thing which you can look at is the amount of investments which have been done in loans and advances to the subsidiaries or the associates, or investments which are there. So from the banking perspective, if this amount is higher vis-a-vis the current assets or the total assets which are there, this is a possible case of fund diversion or a possible fraud which might be brewing up, right? So that is the kind of way in which you can use the ratio analysis. You can use it for comparing for the particular period vis-a-vis the same period previous year, or same period, same quarter previous year. So you can do that analysis time series wise or product wise, or you can have different kind of cuts of the data which is there to do that kind of analysis. Finally, the key risk indicators we have been talking. So these are the early warning signals which are there, where the frauds are likely to occur or which may be occurring, and it gives you a warning signal. Just like when you are going on a road, you will see the red light on the road, which tells you that you have to stop, you have to look around, and then only you can go forward, right? So that kind of a thing will be there in terms of the key risk indicators which are there. One point which I would like to leave with you is that the key risk indicators need not be just financial. It could be even non-financial, just the way I gave you the example of the network activity which is there, which will be one of the indicators which will be there, right? So these are very, very useful things which will be there. So cyber frauds will typically use the non-financial indicators which will be there. So number of login attempts, failed login attempts which are there. So typically the organization will lock the users after say 3 unsuccessful attempts. So number of cases in which such unsuccessful attempts are there. Now in this case, there is no financial transaction which is happening, but using that as an indicator, you can see that is somebody trying to enter into the organizational hierarchy, try to take advantage of the password related controls which are there. They are trying to bake into the password related controls or not. Right? So that is the kind of thing which you can do with the financial activities. So contribution margin, budgeting and variance analysis, ratios, and the key risk indicators, these can be used. We will look at some of the examples of the key risk indicators which are generally used across the industries. This is like which are normally being used across the industry key risk indicators. I have just tried to sort of capture some of them to give you a flavor as to what kind of indicators which are typically used or can be used. The second important sort of tools and techniques which is there is the data mining and the analysis. So with the advent of technology, this particular sort of technique, the data mining and the data analysis techniques which are there, they are becoming very, very prominent. And as Anuj was talking, how we can add value. So if as a chartered accountant, we are able to get an insight into how that data is analyzed. We anyway have the knowledge of the business, what data is useful for us, what is the interpretation of the data which we know. But if we also build skills around it as to what kind of data analysis which can be done or what kind of tools or techniques which are being used, then we will be able to add value in terms of the services what we can provide. So in terms of data analysis, few peculiarities which are there, which I would like to bring it to your attention. So what is happening in case of the automation which is happening, the computerization which is happening, all the organizations are now using ERP or core banking, payment systems are all automated. Most of the applications, the banking applications are also automated. You can connect with the banking applications directly through the technology means. So there is a lot of data which is getting created, which is there. But this data comes from the diverse sources which are there. So what happens is that this data which is there, it lacks relevance or it lacks the clarity or the accuracy which is required. So in many cases, what happens is that we are data rich. We have got the rich data which is available, but the information is poor. So if the information is poor, obviously your knowledge extraction will be poor and you will not be able to do any actionable metrics out of it, any actionable actions you can take based on that data. The other thing which is there is that because of the large amount of data which is there, the manual interpretation of that data or understanding that data becomes very, very challenging. And that is the reason why data mining has become a very popular tool which is there. So data mining is a collection of techniques and algorithms which are there for unraveling the patterns which are there concealed in the large amount of data, which a human eye cannot detect or a human brain cannot understand or fathom. But the data mining techniques will be able to extract that patterns which are there concealed in the large amount of data which is there. So data mining can be of two types. One is called the descriptive. So in this case, what happens is that whatever information is given, it is presented in form of charts or graphs or other visual aids which are there. So there is no knowledge behind it. It's only presentation of the information which is there, right? The other type of data mining which is there is called the predictive, which is there. So in case of predictive, it will draw inference from the data. It will draw the inference from the patterns which are there, the trends which are there, and it will help you in terms of taking the suitable action based on the patterns or the trends which are there. Right? So that's the kind of tools and techniques which are there. There are a lot of tools which are available in the market for data mining which are there, and I'll cover a couple of them in few minutes from now. The other point which you have to also understand is that the data which is coming nowadays, it's not just the structured data. What do I mean by structured data? For example, if it's a sales invoice which is getting captured in the in your ERP system, right? So what you are capturing the customer ID, you are capturing the quantity, you are capturing the price, the invoice amount which is there, and all this will be stored in the database, and this will be stored in form of rows and columns which are there. So it will be stored in a very, very structured fashion. So that's why it is called the structured database. But what is happening now is that apart from the structured databases which are there, there is a lot of data which is useful for the fraud prevention and control, but it is not in such structured fashion. And to give you an example, simple example is an email, right? So if you look through that email, there are tools which are available which can do the sentiment analysis and which can predict whether the person is likely to do something wrong, right? So that kind of a thing, that email cannot be stored in the structured database, because what you are going to write in that email will be different for each person, right? So that will not be able to store it in the structured database. Another example is in case of voice. For example, in many fraud investigations now, voice is used as a sort of evidence which is there. In many cases, the video is used as an evidence, and you would have seen in recent news items that the telecalls or the WhatsApp chats which are there, or the recordings which are done through the camera, they are being used as an evidence which is there, right? So all this information is now also available, and that might also be useful for us in terms of fraud prevention and detection. And I can definitely say from my experience that banks use the social networking related information which is there. You log in on Facebook, what activity you do on Facebook, what kind of posts you put, what kind of sort of messages you put, what pictures you put. All this information is actually giving the information about you to the outsiders, right? So that is used by many of the organizations for their business activities, but the same can be also used for the fraud detection also. So for example, there is a fraudster, he puts a picture at a hill station, right? So the policeman can find out where that person is located, right? So that kind of a thing will be useful from the fraud detection or investigation perspective which is there, right? So that's a reason there is a new concept which has come in, which is called the big data, which will allow you to store this unstructured type of data which is there, and you will be able to extract that information which is there as and when you require. And many of the organizations are now moving from the structured database to this unstructured database, which is called the big data. You would hear it as a jargon, but that's the sort of nut and bolt behind the database is what is there behind the big data. Another jargon which you might be hearing quite often nowadays is called the artificial intelligence and machine learning. So these are the two, again, tools which are available now, which can help detect the patterns which are not very visible to human eyes. So if you have got the large amount of data which is there, the patterns can be recognized out of it, and you can find out which are the data points which are there, which does not meet the normal pattern which is there, and you will be able to detect that pattern as well as outlier using those artificial intelligence or the machine learning related algorithms which are there, right? So the data analysis, what it will help you to do is to visualize the data by using the trends, patterns. You will be able to project it in form of graphs, charts, and all that kind of stuff. You can also use the mathematical algorithms or the models which are there to get some ideas about the patterns which are there, right? So that is the kind of thing, the power which is available for the management accounting folks, which they can leverage. They have got lots of data, structured, unstructured, available in various shapes and forms. If you are able to master this, you will be able to increase the value substantially. One other point which I would like to put it on the table is that not only you can get the patterns which are there, you can correlate it with the external events or the industry statistics which is there, or the macroeconomic data is there. For example, you get the information which is there relating to, say, your sales analysis which is there. You can compare it with the industry average which is there. You can compare it with the macroeconomic trend. If you are showing a fantastic increase in sales when the economy is going down, it means that something is going wrong. It might be that the sales are inflated for some personal gains. That might be an inference which can be drawn. Of course, I am putting a caveat here. Not every indicator or a warning signal is a fraud. You have to do the investigation which is there. And based on that investigation only, you can conclude whether there is a fraud happening or not. So three major techniques which are used in data analysis. First is called the association analysis which is there. So what you do is that you try to link the data and the attributes together, and you create the some sort of association between it. So this concept was typically used in case of marketing, where and a classic example which is given of a nail and hammer. So whether to put the nail and hammer together on the shelf or not of a hardware store. So what the organization will do is that it will analyze the purchase, analyze the sales which are happening, in which cases the nail and the hammer was purchased together, and they will try to plot it, and that particular activity of plotting is called the Boolean vector. So you will try to put in 0 and 1, whether it happened or it did not happen. If it happens, it gives you a credible evidence. If there is a strong credible evidence, then it makes sense to have that kind of arrangement in the hardware store, right? So that is the way it is typically used in the marketing context, but you can also use it in terms of the in the fraud prevention and control case also. So going back to our corruption case, you can find out in which case particular vendors' invoices are processed only by one purchase executive, or a particular vendor is only talking to a particular purchasing agent who is there, that kind of association. Or you can find out that when the say inventory theft happened, who was the store supervisor, what was the level of inventory theft during this period, who was the supervisor at that time, vis-a-vis that during the previous periods. You can do that kind of association, and you will be able to draw some conclusions based on that. So association analysis is one such mechanism which is used. The second mechanism which is used is called the cluster analysis. So in case of cluster analysis, what you do is that you put the data elements which are of similar nature in one cluster. And the cluster is defined in such a fashion that the cluster will have the homogeneous characteristics between all the elements which are there, the members of that particular cluster, but they will be completely different vis-a-vis the members in the another cluster. So there will be homogeneity within the members of the cluster, but heterogeneity vis-a-vis the members in the other clusters which are there. So that kind of a cluster analysis which you can do, and there is a tool which is available, and there are multiple tools which are available. So SPSS is one such tool which is there, which can help you do that cluster analysis which is there, and it has got some sophisticated techniques which are available, like K-means cluster or two-step cluster, that kind of a thing which is there. So the advantage in case of cluster analysis is that it does not assume, it does not make any assumptions regarding the data or the way in which the clusters are going to get formed or the members of the clusters which are there. So there is no assumption like a normal curve for the data, or there is no statistical assumption regarding the curve. Based on the homogeneity of the data elements which are there, the members of the data, the clusters will get formed, and based on that, the cluster analysis can be done. And one such example which can be used, which has been used in case of insurance frauds, right? So for example, what you can do is that you can take the number of frauds which have been filed, right? and you can look at the number of attributes which are there relating to that particular fraud. You can create a cluster out of it, and then you can create a rule relating to that cluster, and you can find out what are the data elements which are there which does not fit in the cluster. So you may find that if there is based on your past experience, you find out that if there is a time lag between the claim date and the submission of the claim and the payment of the claim, if there is a wide time lag which is there, there are chances that there is a collusion which will be happening and there will be a fraud which might be happening. Now, based on your past experience, you have this conclusion. So you will try to create a cluster and you can find out how many such cases are there where the particular claim which is there, which occurred today, the claim is made 3 months down the line and 6 months down the line, it has been settled. Vis-a-vis in other cases, the claim has to be lodged within 7 days and normally within 15 days, the claim will get settled. So it is define that particular pattern, which will tell you that is the way you can use the cluster analysis which is there. The third technique which can be used is called the outlier analysis. So outlier analysis, as it says, it is the case where you will find out the data elements which are there, which does not conform to the required standards which are there, right? So it does not fit the behavior of the other data elements which are there. So that is why these are called the outliers. Now, outliers in typical statistical way, when we are building the models, we typically ignore them and take the homogeneous data elements. But in case of frauds, these outliers are the more valuable than the homogeneous elements which are there. And typically, the outlier analysis is very, very popularly used in case of credit cards. And to give you an example, how that is used is that, for example, I am based in Mumbai, right? And I normally do transactions in Mumbai. My transactions are in the range of, say, between 2,000 to 10,000 in a month. And that has been my trend during the year, last 12 months, which is there. Right? Normally, I go and have purchases in grocery, or I do petrol, or I do some small shopping here and there on some e-commerce website, and that is what my spending pattern is there. Right? Now, assume that an event happens that there is a card which is swiped in New York for a cab expense which is there. Right? So that will trigger an action, an investigation that. If I'm not a heavy foreign traveler, I'm living in Mumbai, I'm spending in Mumbai. How come suddenly there is a cab expense which is happening in New York? So that kind of a thing will be there. If suppose there is another transaction which happens in, say, Singapore, which is for the purchase of Apple phone, which is there. Now that Apple phone will be 50,000 or 70,000, which is not in line with my normal spending habits, which will be there, right? So that will give a warning signal, which will be there. And that will tell you that, okay, something might be going wrong. And that is why the investigation will have to happen. The investigation may prove that it is a genuine transaction, or you may be able to stop that particular fraud from happening, right? So credit card industry typically uses this outlier technique very, very effectively. The third type of technique is called a statistical technique. So here what typically happens is that there is a model which is built, which is called the Binesh model. And what that model tries to do is that it tries to identify the relationship between the various the accounting ratios or the accounting information which is there. And if anything does not fall in that particular pattern, there is a likelihood that there is a sort of falsification of the accounts which are happening, or the manipulation which might be happening relating to the financial statements which is there. So this is the Binesh model, which is typically used in case of regression. In case of banking and financial services industry, they use the Heisman Z-score model, again very similar lines, where based on the financial ratios, it tries to predict which are the borrowers which are likely to fail, which are likely to default, and that's the way they are typically expected to use the thing, right? So that is how the tools and techniques which are available at our disposal, which can be used. I'll move to next slide. I'll not spend a lot of time on this. It is a very verbose slide, but what I would like to leave you with is that there are a lot of key indicators which are there, which are available, which can be used for the common fraud events which may happen across the industry. So for example, in case of revenue, abnormal increase in sales in quantity or the amount vis-a-vis previous quarter or the same period previous year, or sales returns related statistics, or data turnover related or inventory turnover related statistics. In case of personal greed, example, what we talked about, you can do an analysis. Who are the super performers who are achieving the sales targets and who are achieving on a consistent basis, right? So these could be potential cases where there could be frauds which might be happening. Similar thing you can do for purchases where the quantity related or the return related you can do. You can do even the analysis where the requisitions are approved by the same employee. Invoice and the requisitions are approved by the same employees. Purchases are done without the purchase order. So you can run some queries, some reports, and which you will be able to find out if something is going wrong in that particular case. You can also look at the purchase orders which are subsequent to the supplier invoice date. What it means is that you did not follow the process, you try to circumvent the process, you do that. Or you have done the purchases without the competitive quotes, which are the cases where you have not followed that competitive bidding process which is there. Similar thing you can do for inventory or supplier payments, receivables, cash. These are pretty standard ratios for the analysis which we do as part of management accounting. This is an extension or the calibration of the information. What I was talking in that financial statement versus accounting versus management accounting slide. So here either we are creating some new ratios, some new reports or analysis, or we are calibrating the existing information which is available at our disposal, and we are trying to analyze that. So that is the way we can use it. So what I will do now is go something industry specific, how the banking industry has been trying to use the management accounting techniques, at what kind of tool, techniques, reports which are being used by the banking industry to detect, prevent, detect, control the frauds which are there, right? So banking, as you know, is all about lending money. So credit becomes very, very important, which is there, right? So credit appraisal becomes very, very important. And obviously the financial statements which are prepared, they form the basis, including the projected financials which are there. They will form the basis for granting the loans which are there, right? So there are different types of ratios which are being used, and these are financial ratios which we have studied or we have used it as part of our syllabus multiple times. So you will have the debt equity ratio or the interest service coverage ratio, EBITDA ratio, or the turnover ratios, or the collateral coverage ratio, loan to value ratio. So these are the ratios which are there, which are either the extension or additional ratios in addition to what we normally use in financial statements, which will be used, or it could be an example of calibration of those ratios. So what will happen is that the financial institutions will typically specify what is the minimum standard. So they will say that if you are lending against the house, then it will be 80, loan to value ratio should be 80%, which will be there, right? Debt equity ratio should be 3:1, right? So that kind of a thing, the financial institution will typically lay out, and it is expected to follow that particular norm, right? So how it can be used for fraud prevention in control is that you can run a report and find out the cases where there are deviations which are vis-a-vis the norms which are there. So in which cases the loan to value ratio is not 80%, it is higher than 80%, which is there, right? So whether that was approved properly, do we have the proper documentation for it? You can look at all these aspects. If everything is fine, we are good. If it's approved properly, the documentation is proper, there are no concerns regarding the ownership of that particular assets, we are good. But looking at that particular item, you may be able to get some early warning that maybe that was not approved properly, or whether that property is not valuable, valued at such a value, or the ownership itself is in doubt. You can find out such anomalies or the outliers out of that particular exercise which is there. You can run this type of thing over the different types of ratios which are there. So there could be number of deviations vis-a-vis the debt equity ratio which are there, right? So debt equity ratio related deviations will tell you that we are taking the higher risk, and possibly this could turn into a fraud, right? So that kind of a thing which might be there. The debt equity ratio which is not meeting the criteria, on the flip side, could also mean that the owners are actually taking out their equity and keeping the debt as it is and increasing the risk. In many cases, especially in the SME borrowers or mid-corporate borrowers, we have seen that kind of a situation, that the debt equity ratio has suddenly changed during a period, and on further analysis, you find out that the owners have actually taken out their money out of the business, right? So that kind of a thing which has happened without the knowledge of the bank or the financial institution is a possible sort of case of fraud which might be there. Right? Another area where the frauds typically happen because the projected financial statements are used, and these are used to grant the loans which are there, right? So typically there are the amount of frauds which I quoted at the beginning, that 1,09,000 crore worth of losses which have happened due to fraud in banking industry alone. I'm not taking other industries like insurance, healthcare, telecom, retail, manufacturing, service. I'm not counting all those, right? Just single banking industry is 1,09,000 crores, and more than 80,000 crores out of it is out of the credit-related losses. And the main reasons for credit-related losses is that manipulated financial statements were used in the credit appraisal. The owners diverted the funds out of the business into their associates, or invested in some unrelated activities and siphoned off the funds which are there, or they took the money against the stock and book dates which were non-existent. That kind of a thing which was happening. So the projected financial again becomes very, very important. So what you can do is that you can compare it with the industry standard as well as the economic level which is there, and you can calibrate that ratio. Does the 20% increase in sale fall in line with the industry standard? Does it fall in line with the economic condition which is there? Now in today's market, very few industries can claim that they can grow at 30%, right? So that kind of analysis you can get out of the information which is getting captured in the loan origination system which is there. You can run these additional tools and techniques which are there to find the anomalies which are there. The second way in which the management accounting is used in case of credit rating models, where a lot of the financial ratios which we calculate normally, they are being used and they are part of the model. I talked about the ultimate Z-score model, which is again using the regression method. What they did was they created the equation and they applied it over the thousands of thousands of companies which are there, to find out the best fit which is there using the regression analysis which is there, and that can predict in terms of the likelihood of the loss which is likely to happen, right? So that is how you can do it. The third area where it is very, very important to use the management accounting tools is the credit monitoring and the early warning signals which are there. right? So here, what you can do is that the borrowers periodically submit the information on half-yearly or an yearly basis. So you can look at the information, whether there is a drastic spike in the sales or in profits or in the investments in associates and subsidiaries, loans into associate and subsidiaries, the debt equity ratio, interest service coverage ratio. You can look at all these aspects, and that will tell you whether something is going wrong. Is there a warning signal which is there? There could be a fraud brewing, and you will be able to detect based on those particular analysis which is there. Another way in which there are other ways it can be used is most of these cases the lending is against the stock and book dates, right? So the level of stock and book dates, the borrowers are expected to submit that information on a monthly basis. So the financial institution can look at the levels of stock and book dates and see whether there are any drastic variations vis-a-vis the previous months or not. You can also run an analysis where there is zero change in the stock value. What it means is that there is no activity which is happening, and that's a cause of concern, right? Because the money is being used, but it is not being used for the purpose for which it is used, it is granted, right? So it's a case, fraud, early warning signal of fraud you can determine based on the stock and book date values which are there. One other reason why the frauds have happened is that the financial institutions have lent the money without perfecting the security, right? So you can run a report on the cases where the money has been disbursed without the perfecting the stock and without perfecting the security which is there. So higher the number of such cases are there, you will have to evaluate whether they were done with proper approvals or whether it was done in a clandestine fashion. If it was done in a clandestine fashion, then of course it's a sure shot case of fraud which is there, right? So there you can run a sort of reports or create an additional analysis based on the data to find out such cases which are there. Another case which is happening in many cases, the financial institutions are having either a credit audit or they are having stock and book date audits where the auditors like us go to the borrower's place and evaluate it. They look at the documentation and everything and establish the values, right? So in this case, if there are long outstanding stock and book date related audit findings which are there, that could be one other indicator which will be there. So if that is not getting sort of rectified in a timely fashion, that means that something really is brewing up over there. That is the reason why those deficiencies are still not rectified, right? So you can use that kind of a technique which is there. The fourth way it can be used is the looking at the transaction numbers and the amounts which are there. And I would like to quote a case of Bank of Baroda in Delhi. So what happened in this case was that the branch was opened recently. Some fictitious accounts were opened in that particular branch, and large amounts of forex remittances were made to countries outside India, like Singapore, which ran into almost 6,000 crores. So these forex remittances were done to these forex outside parties through this newly opened branch, and this money was transferred as import advances. So it is an advance given for some import which was likely to happen. There was no import which was expected to happen. It was such simple fund diversion which the borrowers were indulging in. Now, if you had this, unfortunately, this fraud was not detected. It was detected once on happening, right? But if you had put in a management accounting report as to what are the number of transactions or the type of transactions which are there, and you compare it with the normal branch which is there. So 6,000 crores worth of forex remittance in a month is even higher for a normal branch. And it's even more illogical for a newly operated opened branch, right? So that could have triggered some action and it could have stopped the fraud from happening. You could have prevented the fraud. Unfortunately, the controls were not at that level. Now the banks are improving their controls, and many of the banks have put in those kind of controls which are there. So you will be able to find out cases which are there, where there is an anomaly or an outlier kind of a thing which is there, which is not in line with your expectation. It does not fit with your normal behavior which is there, and that is where you can use it. Last but not the least is the most of the banks use the customer and product or a region wise or a staff wise. They can go down to the management accounting to that level to identify what is the profitability per customer, per product, which region, which branch, which staff member is contributing to the profits. You can go down to that granular level using the management accounting hierarchies which are already available in the banks which are there. How you can use it for fraud prevention is that you can identify which are the cases where there are abnormal increases which are there. I gave you the example of the super performer staff which is there, right? So if some person in a branch, nobody else is performing, but he's performing, he's a super performer, the only person in the branch, right? That kind of a situation is a possible trigger that there could be something going wrong. I'm repeating again that such a trigger is not a definite case of fraud. It's an indicator or a warning which is there that there could be a potential fraud which might be happening, which is there. Similar case, you can look at abnormal increase in the profitability which is there per customer or per product, or some branch or some region is showing exceptional level of profitability. Other regions are not showing that kind of profitability, but some branch or some region is showing exceptional level, or it is not in line with the economic reality which is available. That kind of a situation will give you a trigger to investigate further, and you may be able to prevent or detect fraud. So with that, I complete my presentation. I hand it back to you, Dr. Paul and team, if you to take it further.
So may we proceed for the Q&A session?
Yes, sir. I would be happy.
So the first question is, tell us the procedure for implementation of management accounting. How management accounting taken place? Also tell us about practicality of management accounting.
Okay, so I have tried to articulate what is the financial accounting and management accounting. So what you are trying to do through management accounting is to have a more granular information, financial as well as non-financial. I gave you the example of electricity, right? So incidentally, State Bank of India, what it did was it analyzed its electricity expenses and it found out how many units are getting consumed. And what they concluded is that if they put solar panels in some of the branches where there is a high consumption, they will be able to reduce the electricity cost which is there, right? So that kind of a thing, you can do it based on the thing which is there. Just hold on for a second. Let me just plug in my electricity. Give me a second.
Sure, sir.
Yes, sir. Okay, so story, how to implement management accounting. So typically, a lot of information will get gathered through your ERP system, or if you are in any other non-banking kind of scenario, if you are in banking, a lot of information will get captured through the core banking, right? So what you will have to do is that you have to set up the hierarchy, as we call it. So product, region, branch, customer, these are the product. These are the kind of elements which are there on which you would like to do that analysis. So you will have to set up your accounting system in such a way that this information gets captured when you are capturing the transaction, and you will be, or you can do it through the GL setup also, where you can do what you can do is that particular GL will correspond to a particular product code or a particular region. You can set it up that way. So what you will be able to, the first determining point in setting up the management accounting system is that what do you want to analyze? What is of importance to you? And based on that, you will have to set up your accounting system. So that is one important source of information which will be there. The second information source for management accounting will be the peripheral systems which are there, right? So for example, in case of bank, it could be the payment system data which will be there. Or in case of manufacturing, it could be fixed asset register, the inventory related records which are there, or any kind of other peripheral systems which are there from which you can collect the data. Typically, what the organizations are moving, and this is across the board, many of the organizations, and I will dare to say that majority of them are setting up the data warehouse where all this information will get captured. And so you will get all the information from disparate data sources which are there. And the data analysis, what I talked about, you can run those queries on that particular data to get the required information which will be there for you. What you can also do is that you can create the periodic reports which are there, which can be given to the designated users based on the requirements which are there. So some could be for in form of dashboard, which will give you the snapshot of what is happening in the organization. There could be for senior management, there could be for middle management, there could be operational level reports. So you can create a lot of reports which are there. The idea behind the management accounting is that it will help you in creating an actionable matrix for your business decision making, right? You will be able to improve the efficiency. You will be able to take your business decisions. And third activity which I have added is the fraud control, and we discussed how that can be leveraged. The same techniques, the same data with enhancement. Now, in case of management accounting, typically what I have been talking is the financial accounting data. But you can also get other forms of data. Like I gave you the example of cyber risk, for example, where the network activity related monitoring which is there, that will get triggered and some report will come, right? Will get generated. Or you may get that alert on your mobile phone. Nowadays, the technology has become so advanced that you don't have to print out a report. You can get these reports online, real time, 24/7 on all your mobile devices, be it on iPad, on your mobile device. In many cases, you can even operate remotely to take corrective action based on that if you have to run something. Like, for example, you run a query on the data, on your all the IT assets which are there, for which the virus detection software has not been loaded, or it has not been updated, right? So you can run a report. This is a non-financial report. You will not find this particular information. So what you will have to do is that you will have to get that information from the respective data sources, consolidate it. Typically, it happens in either a separate tool, monitoring tool, IT monitoring tool, or you may get it in the data warehouse where you will combine all this data and you will create a meaningful analysis. I hope I'm able to answer that question.
Yes, sir. So the next question is, what three basic ratios or three parameters we should use or check to find out if any the company?
So it all depends on the. Okay, I would like to actually state this. I forgot to mention it initially. So a few things as a takeaway from this session, I would like to just put across while answering this question. So what is happening is that if you look at our Indian economy, previously it used to be 70% manufacturing, 30% was service industry or the IT or all the other activities which were there, right? But now the proportion is reversing. So it is 70% service and 30% manufacturing. That kind of a ratio is happening, right? So the tools and techniques what we were using for a manufacturing industry may not be suitable for our current situation, right? So that is first takeaway to answer that question. Second takeaway is that each industry will have its own peculiarities. And I gave you the example of banking. Now that same example, you cannot apply for IT industry. Now, if I have to take IT industry, the most important parameter which they will track always as part of management accounting is the number of staff which is there and the staff utilization which is there, right? So how many number of people are there in the organization? Because in many cases, they are billed on a time and material basis. So if a person works on the job for a month, the client is billed on a monthly basis. Or it could be a staff utilization kind of a case where I'm working on the project. I'm not getting billed on a monthly basis, but I will get billed as per the project costing methods which are there, right? So that kind of a thing which will happen. So they will try to track, is there a drastic variation in the staff numbers and all that which are there? And I gave you the example of Satyam before, right? So here what they tried to do is that they wanted to meet the analyst expectation. They want to maintain their earnings target and all that. So what they created was the ghost employees to show that the sales are increasing, to show that they had to show that the receipts are also coming. So that's why they did the bank account related manipulation which was there. And if you read through the case study, it was not just in one account the fraud actually happened. It was done across the multiple areas which were there, right? So you have to have each specific industry-wise, the ratios will be important. If you take the healthcare, for example, right, then the per patient billing will be there. How many patients are there? Per patient billing will be very critical. If you take retail, e-commerce website, then what is your order value per customer? How many items are there in that particular order? What is the value of that order? That might become very critical from the business decision making. If you look at it, I'm taking this example forward of the e-commerce website. So what do they do for fraud prevention and control, right? You try to return the material 3 times. On the 4th time, you will be blacklisted, right? So that is how they try to control that you are not using their goods free of charge for some time and returning it, right? So that kind of wrongful gain you are not getting is what they are trying to get at, right? So they will try to put in that kind of a thing. The card related control, even they will try to ensure that I'm based in Mumbai, I place my order in Mumbai, suddenly I place my order from New York, right? So that will be there. In fact, while logging in itself, you will get a message saying that there has been a login activity from New York. Where did you log in? That kind of a thing. Google is another very interesting example. I have been involved in one of the IT companies where we used to handle their account. And they have put in a very sophisticated algorithms to find out such behavior anomalies which are there. So you will find that if you are logging in from a different laptop, you will get a message which will say that did you log in? You logged in from a different laptop, or even the Windows version which is there on your laptop. If it is different, you will get a message. So each industry will have a different flavor which will be there, they will try to monitor from the business decision making or from the fraud perspective. I give you 2 such examples. So there is no standard set of things like the one which I gave you, cash, or for example, property, plant and equipment, or purchasing. These are standard ones. If you are doing it, vendor management, these are like the standard ones which are there. Be it manufacturing or be it any other industry, it will be still applicable. But having said that, the level or the rigor will be different. So I mentioned about the proportionality principle initially, right? So in case of manufacturing industry, the level of purchases will be exceptionally high vis-a-vis say IT industry, right? So where they will be buying maybe some laptops, some small stationery here and there, their purchases may not be that great vis-a-vis the steel industry which might be there, right? So there is no hard and fast rule as to what you should monitor, but that is how you will try to do it. One other point which I have to look at it is that one thing which we have all observed is that as we are improving, the fraudsters are also improving. And this has been noticed especially in case of cyber frauds, where you will find different news items every day that how the fraud has happened. So that as the fraudsters change their methodology, we also will have to put in additional ratios, additional control, additional report to find out that particular case which is there. right? And that is where the tools like say data mining tools or artificial intelligence or machine learning, which can help in identification of or the patterns or the frauds which are there. One point which I did not cover actually, and I would like to cover it as a closing comment on this particular question, is that not only the fraud prevention and detection should be for today, but it should be for forward looking also. And I will give you the example with the banking and financial services industry. So we have faced COVID, right? So what has happened because of the COVID is that the property prices have suddenly dropped. There are no buyers for the properties nowadays. So the bank may have lent the property, assuming that it will be 80% loan to LTV value, but the value will drop now, right? So if the value drops, the bank is exposed to risk, right? So that is what will be happening. So what will happen in future is that when the new proposals come, there might be a situation where the borrowers will try to manipulate the value of the property so that they get the higher amount of loan which is there, right? So that risk will have to be understood, and you have to take actionable metrics around it. So what the banks would have typically done is that they would have reduced the loan to value ratio from 80% to 70%. In the bank where I am working, we also did an analysis of the properties where the loan to value ratio will drop, assuming that there is a 20% drop in the value of the properties which are there, right? So that kind of a forward-looking activity also needs to happen as part of the management accounting. It is not just static at a point of time exercise. It has to be also forward-looking. I gave you the example of stock and book dates. More and more people, cases might happen now in future where that values will be manipulated. So we have to keep a close eye on such cases where the values are higher, the economic activity is not happening, but the inventory values are increasing. All such cases will be the outliers, which will need an investigation. So I hope I'm able to answer that question.
Yes, sir. Sir, the last question of the session. Sir, how to identify ghost employee if employee ID and appointment letter have been generated?
Okay. So one of the simplest ways to look at it is to see whether he has logged in. Well, normally you can find out from the machine IP which is there, right? From where he is logged in. Nowadays, even the tools which are available, which can find out the location of the employee also, right? You can also identify one other interesting case which is there in case of employees is that when is he logging? Is he logging in at a particular time, or is he logging in at an abnormal hours, right? Say 11 o'clock at night, you will find an account entry will be there for his login. Because if a ghost employee is there, say for example, 1,000 ghost employees are there, you will have to log in from 1,000 different machines on different machines which are there. You will have to have those 1,000 logins which will be there. They have to log in. You can also see how much time the person has logged in on that particular machine, what kind of activities which the person has done. Even you can look at that kind of a thing. So the tools nowadays, monitoring tools which are available, they have become very sophisticated. And in some cases, you can have even the sensors which are there, right? So if an employee is there, then you can even see whether where is he sitting? He's sitting in Bangalore. So are there sensors, motion sensors which are there? Many a times those motion sensors are used for lighting the equipment, the tube lights and all that. But that kind of a data is even available to identify whether there is an employee which is there or not. So there are techniques which can be used which are there. It is not a foolproof mechanism that if the management itself decides to do a fraud, it becomes very difficult. Management fraud is the most difficult fraud to find out. That's the case even in case of Enron, where the management itself was involved in the manipulation of the accounting.
Thank you so much, sir, for such a wonderful Q&A session. Now I would like to hand over the mic to my HOD, sir. So please.
Thank you, Pradeep. God bless, sir. Thank you very much for explaining beautifully the various concepts of fraud and what are the management accounting techniques for fraud prevention and control. Even just know your goods are very nicely explained what are the ghost employees and how that can be taken care of. And basically, I have also used the various examples in the banking industry, which I am sure the listeners, that is our chartered accountant, must have found it very useful. So I once again thank you, sir. I also thank you, C. Anuj Goyalji, Chairman, Committee on Management Accounting in absentia, and C. Rajendra Kumar P, Vice Chairman, Committee on Management Accounting in absentia. And I also thank you, everyone, including the listeners, for attending this webinar. Thank you very much to everyone. Thank you.
Thank you very much, sir. Thanks for your time and thanks for giving me this opportunity.
Thank you, sir. Thank you.
Thank you, sir.
Thank you.
Thank you.
Thank you.